Wesley Gray will be presenting to us. He's CEO and CIO of Alpha Architect LLC. The name of his presentation is Factor Investing is Simple, but Not Easy.
Good. I actually just today updated my title on this thing to make it more transparent, what I was trying to communicate. It's obviously pretty relevant given the recent market chaos. But so now instead of factor investing simple but not easy, I'm going right to the point. Factor investing, no pain, no gain, and that'll be the probably my new title as we go forward here whenever I do this sort of presentation. So let me see if my mouse works here. All right, so I'm not going to go over bio stuff, but basically been doing this for a long time. And I'm just here to help share some knowledge for the team out there. And so the plan and the kind of the agenda, what I wanted to cover was just first, what is factor investing? Second, are factors dead? Like, is this just a total waste of time now? Why did factors work? Because we know certainly after the fact that they work. That's why people have been interested in them, at least until recently. And then really probably the most important question is, will these factors work in the future? And kind of a summary of the results up front, in case you get really bored, is factor investing is basically Moneyball for finance. And I'll explain what I mean by that. Are factors dead? You can never say never, so it is possible, but I do think it is unlikely. And then why did factors work historically? Well, arguably it's because of you're in general owning higher fundamental and career risk, and these have been compensated in the marketplace. And will factors work in the future? Well, to answer that question, it really depends on your priors and understanding of, do you believe that fundamental and career risk will be compensated in the future? If you don't, then factors probably won't work. And if you do, as I'll explain, it's arguable that they probably will work over the long haul in the future, just as they have in the past, or at least, it may rhyme a little bit. So that's the summary of what we're going to talk about here. So first, just to kind of kick things off, this is a 10-year chart ending in February. If I added the last 2 weeks, this thing would be even crazier. This is essentially the spread in returns between cheap and expensive securities. So anyone who looks at this chart and sees that value essentially is off of expensive or growth or whatever you want to call it by 50 points, that's, again, it's probably 60 points now. It doesn't take a PhD in finance to tell someone that, value looks dead. And this is one of the primary arguments for that statement, and that makes a lot of sense to me, but we're going to investigate. So before we even tackle that, because value is considered a factor, I just wanted to step back and make sure that we understood what factor investing is, because a lot of people are just unfamiliar with the topic. So I want to start kind of 101. Basically, the easiest analogy that I can come up with is this concept of Moneyball, where you folks out there in California, especially near Oakland, you might be familiar with this idea. But essentially, the idea of Moneyball, which is in a book, is that what happens, the Oakland A's were trying to beat someone like the New York Yankees, who can just spend money to buy players, and they have unlimited resources. So the A's, they had to come up with a better idea. And what they said is like, well, instead of hiring all these scouts and wasting all this time talking to the players, why don't we just use data? Like, can we just use the data and the stats on the players and use that data to maybe predict outcomes, and then we can take advantage of that, because if the data says that the outcomes are good and the price is cheap, well, let's do that, because the computer is pretty cheap compared to hiring a bunch of scouts. So I'm just, paraphrasing the concept, but that's basically what people were doing in baseball, and that's basically what factor investing is doing. What factor investors are essentially trying to do is identify different characteristics associated with a security, and in hopes that these have some sort of consistent or roughly consistent relationship with expected returns. And I just put some examples here. A lot of people use things like price to earnings, market cap, which would be like size, return on assets might be quality. And when we look at these characteristics of these securities, one might build a model where they think that, wow, low price, small quality stocks tend to do better over the long haul than, big, expensive, low quality stocks, for example. And again, it's just money ball for finance. So can't see you guys, but hopefully that makes sense, and everyone's kind of tracking on the high level of what factor investing is trying to achieve. All right. And then what's a basic example of a factor investing strategy? Probably the most basic that a lot of AAII folks will be familiar with, because you guys have your databases that screen on stocks, is just value. So where value is not like Warren Buffett value where we're trying to stock pick, but it's just buying cheap stocks. And so what's presented here, and this is data over the last 100 some odd years or what have you, maybe a little bit less, is it literally is a strategy that buys the top 10% cheapest securities on book to market. And it just does that every year, and it compares that to the S&P 500. So this is on log scale, just to not, make it too crazy. But this blue line, which is basically the value factor line, is much higher than the black line over the long haul. And so this is why people are interested in factors, because they're like, wow, that's pretty easy. Just buy cheap stocks and we can, over the long haul, make a heck of a lot more money than just buying the market, is kind of the concept. And of course, what a lot of people ask is, well, can it be that simple? That seems pretty easy when, investing should be a lot harder than that. But this is just the data. This is just the facts. So the next question we got to ask is, okay, we kind of know what factor investing is. Value is a classic factor. We know over the long haul it's definitely worked, but it also seems too simple. And so a lot of people ask the question, well, are factors dead? And kind of the core hypothesis here is that factors are simply too simple and competition has killed them. Because in the old days, whatever that means, it's all these maniac stock pickers who are crazy and weird and, do stuff that just doesn't make any sense. But nowadays, the market's hyper rational. There's a lot of people like Jim Simons here. If you guys are familiar with them, he started Rentech, who they've got math PhDs, and they do machine learning, and they do everything, and they just can crush everyone's soul in the marketplace. And long story short, this is one of the hypotheses of why factor performance, in particular value, has had poor performance. Because the idea here is that more brains, which implicitly means higher competition, have led to poor performance. And this is a hypothesis that we want to take seriously because it kind of makes sense at a first glance. But there's a problem with this theory that more brains equal worse performance as a causal argument. And I'll tell you why that might be the case. So what you're looking at here in this chart is that same 1927 to 2018 period, where what I'm going to do here is I'm comparing the 5-year rolling returns of this strategy here, the just buy cheap stock strategy, relative to the S&P. So for example, this point right here, I don't know if you can see my mouse, but it's probably in, 1940, it's around negative 20%. What does that mean? What that means is at that point, the 5-year prior performance, every year on average, this thing lost 20% per year relative to the S&P 500, i.e., you got destroyed by the marketplace in a relative sense. And similarly, anything that's positive means that you were winning over that past 5-year kind of look back period. And so what you look here in recent time is value has definitely underperformed, right? And the argument is, well, brains killed this underperformance. But what you recognize is when you zoom out, that this is actually a fairly common phenomenon. And the idea that value underperforms for 5 or 10 years is actually not rare. It's actually pretty common. So in order to map a hypothesis that suggests that more brains equals poor performance, we would then need to explain from a causal perspective why value underperformed in 1950s or 1970s or 1980s, or why did it outperform in different periods, right? So it's unclear that the more brains is what's driving poor performance, is what's going on. And what it means is we probably need to do a further investigation of what is actually driving value performance historically, which we know empirically works over the long haul, but also over any sort of 5-10 year window, it can always underperform versus the broad market, basically. So why did factors work? Let's try to actually now ask this question, because it doesn't seem like just because there's more competition means that things automatically stop working per se. So what that's going to require is that we actually step back and try to understand an even more fundamental question of investing, and that's why would any investment earn higher returns in the first place? Whether it's, I think the gal before was talking about muni bonds, T-bills, Zimbabwe credit, whatever it is, why the heck does anything earn higher returns? And it seems like a basic question, and as we'll find out here, it actually turns out to not be a basic question. And one of the things that I like to do, and this will be kind of a mockumentary of this, but we can always go ask the Nobel Prize winners in financial economics what they think the answer to this question is. And the great irony here is that the Nobel Prize winners in this field have different opinions about why prices do what they do. So on one side, you have Professor Fama, who's actually my old Ph.D. advisor at Chicago, and he is a big fan of the efficient market hypothesis, which we'll talk about in further here in a little bit. But essentially it says that prices always equal fundamentals because markets are hyper competitive and there's essentially no free lunch and it's easy to exploit dummies, and they get eradicated from the market. Reasonable. But then on the flip side, during the same year, there was another Nobel Prize award in economics. Well, there's 3 of them, but these are 2 of the folks right here. And that went to Bob Shiller. And his hypothesis is that no, prices do not equal fundamentals, because have you ever met these things called humans? And they're crazy. They're prone to narratives. They're prone to bias. They're prone to bad decision making. They're prone to sentiment drifts, hysterias, and what have you. So prices can't be efficient because there's too many wackos out there. So what's interesting is the 2 Nobel Prize winners can't really agree on why investments earn the returns they do, in sample and out of sample. So let's dig a little bit further into this debate. And first, before we begin, just to be clear, because a lot of people are not, enamored in this research vein here as much as I, unfortunately, have been exposed to it. Let's first start with the definition so we're all clear. So market efficiency is generally defined loosely as prices equal the fundamental value of something, okay? Just to keep it very simple. There's no situation where prices are overvalued or undervalued. They always roughly equal fundamental value, and there's no systematic way to exploit deviations from that. And why is that put forth as a theory? Well, really a hypothesis. I guess it's not a theory per se, because it's something that can be tested. But the way it comes about as a hypothesis is the following logic. Essentially, if there's no free money because of competition, so if there's a $20 bill on the ground, this is not efficient, right? Because $20 bills should not be on the ground. That seems like mispricing, because why? Well, if there's $20 bills on the ground, we're going to grab those. Like, I'm going to grab that immediately. Maybe not now because there's coronavirus, but in a normal world, we'd be grabbing that $20 bill, right? And so this would become efficient because when we go look at the ground out there, we never will see $20 bills lying on it. And therefore, it seems like prices equal fundamental value, because if there was a $20 bill for some instant, some really smart person is going to grab it and take it away, right? So this is, in simple terms, the way the efficient market hypothesis works and why prices equal fundamental value. Now, there's a key assumption in here. The key assumption is that it's easy and costless to grab this $20 bill. And so that's why I want to talk about inefficient markets and try to understand and tease at this assumption that maybe it's not the case that grabbing the $20 bill, or in theory, in like the financial markets or in my example here, is easy. So let's take this scenario. Let's say there's the $20 bill on the ground from up here, but for whatever reason, some idiot left the $20 ground on the, or $20 bill on the ground, but there's grizzly bears in the neighborhood, right? And they like the smell of humans, so they go over there and sniff on the $20 bill to check it out. Well, this is clearly not efficient pricing, because there shouldn't be $20 bills just lying out there. But now the smart person is going to look at this opportunity where here it's like, well, that's easy. But now it's like, oh man, if I got to get this $20 bill, I'm going to get destroyed. I might get eaten alive and killed by this, this grizzly bear that's hanging out. So now when we look at pricing in my little fake market here, there's $20 bills everywhere, and prices clearly don't equal efficient market, but it's not like these $20 bills are easy to exploit. So what happens is that empirically, when we look at the market prices, they kind of equal fundamental value, but they have a ton of noise around them, because the reality is smart people trying to exploit these quote unquote opportunities are running into various costs and problems associated with arbitrage, basically. And this is why prices will never equal fundamental value. So this is just a hypothetical example to try to simplify it. And now we'll try to bring this back into the marketplace. But as you'll see, I think the analogy is fairly good. So who's right? Is it markets efficient and everything's perfect, or is it chiller and markets aren't efficient, everything's crazy? The reality, and probably why the Nobel Committee gave both these gentlemen and this other guy named Lars Hansen the Nobel Prize, is they're both right. And in the end, the reason that for any investment or anything we're doing that we should expect to earn potential excess returns out of sample is going to boil down into two categories. One of which is market risk. So if you buy something, an asset that is fundamentally riskier because it's tied to the economy or exposed to, certain situations that aren't favorable, well, you should earn higher returns, because in that buy-sell arrangement in the marketplace, the reason someone's selling you something cheap is because they're basically offloading that risk to you, and you should get paid for bearing that risk. And that's just, fundamental market efficient concept. But then the second one is, let's say there are opportunities for mispricing in the marketplace where people are sentiment driven. Well, someone's got to still own that trade or own that opportunity. And to the extent that it's very painful to own mispriced assets in the short run, this could create its own sort of risk premium. And I like to call this the career risk premium, and I'll explain what that is. But in the end, you got to get your returns from one of these two buckets, and most likely end up being both. And your bottom line conclusion, I think, if you're thinking rationally about how markets actually work, is that it really does boil down to no pain, no gain. There is no free lunch. There is no opportunities to eat for free or do nothing in the marketplace. Everything you're going to do that works, it's either you got lucky, or you got lucky and you were taking some sort of risk or pain on that you should expect to get rewarded for, basically. So let's walk through each of these components now in a little bit more detail. So first, the basic one, market risk. And this is something that should be intuitive. And in fact, it's so intuitive, you can put it on a napkin. right? And I stole this from a guy on Twitter. I gave him his credit down here. I just thought it was such a good idea, so now I use it in my presentations. But essentially, what's this story? Well, on our napkin, we can write down the world of investments on two dimensions: risk on the x-axis, return on the y-axis. If you have low risk and high return, you are in the fraudulent bucket, and you probably invested with Bernie Madoff. We want to avoid that, obviously. On the other side over here, if you're in the extreme risk, low return bucket, you are in stupid land, right? So when your cousin or your uncle says, hey, do my VC investment, it's awesome, and they have no plan, but they're your cousin, so you give them money, well, that's in the stupid bucket, right? Everything else makes sense with respect to market risk. Low risk, low return. That seems reasonable. High risk, high return. That also seems reasonable. So as one lever, one dimension of why you get to win in the marketplace, quote unquote, it's because you're on some range of risk and return. And that, I think, makes sense, sorry, to most people. Now, this other one is a little bit more complicated, and this falls into the Schiller camp. And this revolves around what's essentially is called behavioral finance in academic literature, but I call it, in the end, what is it? It's career risk. And I'll explain how career risk works and is potentially priced in the marketplace. Let me take some water here real quick. So what this is, I'll just explain real quick, is on the right, it says the limits of arbitrage, Andre Schleifer and Robert Vishny. So this is taking a graphic that I've made up from a theoretical paper that was written over 20 years ago now by two very famous financial economists called The Limits of Arbitrage. And they try to highlight to the efficient market camp that guys, and I say guys because it will then and now, it's mostly in finance academics, it's guys, but you girls too, obviously. What they say is, listen, you keep saying that prices are always efficient because it's so easy to arbitrage and exploit everyone. Well, we don't agree. We think there's grizzly bears out there that actually hang out with those $20 bills. And we're going to explain to you why. And so what they do is they tell a story where essentially there's three periods. There is a now, which I label here as T equals 0. There is a short run, whatever that means to you, but we call it T equal 1. And then there's a long run. Again, whatever that means to you, T equals 2. For me, long run might be 20 years, short run might be 5 years, and now is obviously today. Well, let's say that we are the ultimate investor of all time with perfect foresight on everything that's ever happened in the world. Let's just say we're like a, God or something, to keep it simple. So you're this person that has perfect foresight, and you see a security right here at time 0 where you know without a shadow of a doubt that in the long run at T equal 2, it is worth 2 times what it currently is worth now because it is underpriced. Now, you manage other people's money, and you sit here and think, well, if the efficient market hypothesis is correct, what I'm going to do is I'm going to keep buying this security now with every single ounce of money I possibly can until that price just equals 1 penny less than the fundamental value that I know it's going to reach at time 2. So you're thinking that, but then you're also sitting back thinking like, well, wait a second. I've been hanging out in the market for a long time. And I know that in the short run, prices don't always just go to fundamental value. They can get crazier before they get better, i.e. this red path, or they can move towards fundamental value. But here's a problem. In the short run, I have to present to my investors my performance reports every month or every quarter, or now every day if you have like an ETF or what have you, or a mutual fund. And so the problem with this is, let's say I know for certain this great opportunity, but I also know for certain that I don't know what's going to happen in the short run. And in the short run, if I lose a lot of money and I have to go explaining to my clients why I'm so smart, even though I'm down 50%, I know that my business is dead. So I may now sit back here at time zero, knowing full well that this is an arbitrage opportunity in the long haul, but also knowing full well that it would be insane to take advantage of this because I like my job a lot more than I might like taking advantage of long-term arbitrage opportunities. i.e., there's a $20 bill on the ground, but a grizzly bear has it in its mouth, right? That's not a good idea. So arbitrage is not free in the real world. And Schleifer and Vishny try to highlight this through a theoretical model, that this is something we should consider when looking at asset prices and expected returns in the real world. So one thing that we did internally to kind of study this concept to get a better grasp of it is we actually modeled it. So we create this thing called the God portfolio, where we, because we have so much data and we obviously know exactly what happened after the fact, we can actually cheat and we can create portfolios where we can sort the database where every 5 years, like I already know who was the best stocks over the next 5 years because I can look in the database and run a SQL query and it can tell me which names were the best, right? So we're going to actually run a strategy, and I'll explain why here in a second, that actually does that from 1927 all the way up to the present time period, right? And so we actually don't have a final strategy from 2016 because I don't know the 5 years, but it ends on 2016. And so this is the cheating portfolio, the perfect portfolio that owns the top 10% winners by design over the last 90 years or whatever. And sure enough, this is the performance of the perfect portfolio versus the market. So the market earns around 10%, which is amazing, a ton of risk, obviously. And then the God portfolio earns 30% a year over 90 years. It doesn't take a mathematician that long to figure out that if you take 30% compounding to the 90th power, you're going to basically be a trillionaire. So God would be a trillionaire, obviously. So that's no kidding. We already should know this, that you can make that much more money. Here is where it's interesting. So now what we have is the drawdown profile of the S&P, which is in the light background, and this perfect God portfolio, which is in like the foreground. And what you notice is even though this is obviously very compelling and it is perfect, even perfection cannot avoid dying in the marketplace. So these same portfolios here that earn 30% a year, 3 times the market, and we already know are perfect, still engage in massive, massive drawdown risk. So your debt, like Great Depression over here, guess what? The market's down 85, you're down 80. Whoopee! Not really, right? So just because you're perfect and just because you're super active making the best call out there, i.e. you're trying to do the right trade in the long haul, even the perfect investor with perfect foresight will face this conundrum that in the short run, their investors are going to think they're idiots, basically. Because as I showed here, even perfect portfolios look idiotic in certain windows, which is fascinating and scary all at the same time. So if you don't believe in this career risk, I also have some case studies for you. And one is the classic, who I'm sure many of you are familiar with, Warren Buffett, right? So, and Warren Buffett is actually right now in a time period where he's getting destroyed. I'm sure he's probably buying a bunch of airlines or something right now, so we'll see what the story says. But it's similar in spirit to what happened in the late 90s if you were around. And what we have here on the left is a chart of Berkshire Hathaway's performance, which was down 40% almost over a 9-month period relative to the triple Qs, which at the time was what everyone cared about because the S&P was for losers and triple Qs were the internet stocks, right? And so the return spread between value as epitomized by Warren Buffett, arguably the best investor of all time, and what the quote unquote market was doing is 150 points. And this happened in a 9-month time period. Now, obviously, I'm not showing you what happened after the fact because, Buffett goes on to win and he obviously gets proved right. But that doesn't mean that in the short run here that you may not die before you can actually take advantage of your arbitrage opportunity. Okay, case study number 2, factor investing, almost as bad as Buffett situation. So again, I don't have to do much work here. I can just repost up the rolling factor returns relative to the S&P over 5-year windows. And even though value, quote unquote, works over the long haul, which is a factual statement, value also makes you go through such immense times of pain and anguish that it's arguably not humanly possible to actually stick with these programs. And if, again, just to emphasize that these are 5-year rolling annualized returns. So at any point here, like if you're negative 10% down, that means that if you're negative 10% down compounded over 5 years, in other words, you're underperforming the benchmark by, probably 60 or 70 percentage points. And that first chart I showed you at the very beginning, we were off around 45 percentage points, which would probably be something like around, 8 or 9%. And we notice that this happens all the time. So if you think the pain in value right now is bad, which it obviously is, the sad, sick part is it can only get worse, and it has gotten worse many times over. So something to always remember to give perspective when people highlight that, oh, value is painful right now. Well, not really. So that goes to the next question of, so we know why factors did work in the past. They're generally hold a lot of risk indirectly, and you have to deal with this monster career risk problem of owning a lot of securities that have a profile and a return path that is not amenable to keeping your job. So will these factors work in the future, though? Now that everyone knows about these open secrets of, well, we can just buy cheap stocks. Look how awesome this is. Well, that depends on your perspective of why markets work in the first place. And as we mentioned, even if I know the open secrets of value, momentum, or whatever the heck they cook up next, in the end, if I know the open secret, but this open secret maps directly to increased market risk and increased career risk, even though it's an open secret, it still is going to probably earn higher expected returns because there's natural buyers and sellers who want to offload said career risk and market risk onto people who are more willing to essentially embrace that pain, right? So you would think that if you believe that market risk and career risk will continue to earn premiums, then you should expect that factors will work to the extent that they map onto these two different risk buckets in some way or fashion. So you step back, you say, I'm sold. I get it. I'm a long-term thinker. I'm evidence-based. I don't have the bias problems. I'm like Warren Buffett. I can do anything and stick through it over the long haul. I'm ready to earn higher returns. Let's do it. Well, here's the problem. The first problem is the marketplace is not going to help you do it because the marketplace is going to deliver closet indexing strategies that are very protected from all the career risk because they don't want to engage in them. So the chart here just shows the time series performance of the SP 500 against the Vanguard Value Fund. As you can see, not a lot of Ph.D. math is required to highlight that the Vanguard Value Fund is essentially the S&P 500 fund in drag, right? It's not going to deliver the value factors returns. It's going to deliver whatever the S&P is, and that makes sense because it basically owns a lot of the same securities and the same weights, and it's taking very small bets on the value factor, and that's fine. It's just the problem is you're not going to be able to access or try to exploit the opportunity that we're talking about here, the pain train opportunity. And so here's some numbers on just to reiterate, well, why? So what we're looking at here is this is the compound annual performance for generic value portfolios that just buy the 10% or just buy the cheapest, right? But they don't just buy the 10% cheapest. They're going to buy either the 500 cheapest, the 300 cheapest, the 150 cheapest, or the 50 cheapest every year. And then this y-axis is how often they're rebalanced. So we could rebalance them every month. So that'd be a quick rebalance to freshen them up, or we could rebalance them every year. And what you notice is as you concentrate your portfolio and as you turn it over more frequently, there's basically a linear relationship between level of activity and difference and returns. And the more you have a diluted kind of closet index type portfolio, like for example, 500 stocks out of 1,000, and you rebalance it once a year, well, that's basically buying the market for all intents and purposes. And so your performance is going to be like the market, where the more you amp up into the hardcore value stocks, i.e. the 50 cheapest versus the 500 cheapest, you're going to get a lot more higher expected returns because you're loading more and more up on this value factor. Well, that sounds great until you get to this slide. So this is the same portfolios, but they're tracking error. Where tracking error, if you don't know what that is, simply is just deviations from the underlying benchmark. And as one would expect, the further you are to this bottom right corner, the lower your expected deviations are from the broad index, i.e. the VTV type portfolio. And as you ramp up into career risk land here in these concentrated higher turnover value portfolios where you could die and lose your job, sure, you can get higher returns, but that's insane because you're going to have to deal with everything we've been talking here, which is these 5-10-year runs of underperformance. And in general, asset managers value their jobs, and so they're going to generally build portfolios that lean to construction setups that are more like those that have low tracking error and kind of low return differences from the index. And that's a trade-off that they choose to do, which is reasonable. But you might ask, well, fine, that's great. So all I have to do is I either got to buy index funds or buy index funds that are called factors and, you know, pay too much fees for it. Is there anything else out there? Like, is anyone out there crazy enough to actually do these super high active share concentrated factor portfolios that are guaranteed to have you lose your job? Well, fortunately there is, and that's me. I'm that idiot. But this is what we do. This is basically our niche business. So we have like 5 clients in the world who are actually crazy enough to do this. But if you do want to do concentrated value or momentum, that's kind of our specialty, right? And so our portfolios have concentrated holdings. And if you're familiar with active share, this is just the level of difference from the underlying index. You know, our stuff is obviously highly different. Again, that doesn't mean good or bad. It just means you're exposed to these factors. And if they're not doing well, you're not doing well at all. If they're doing great, well, you're going to probably do really great. But it's going to come at a cost, as you can imagine. And this is just visualizations of kind of where our underlying index concentrations are in value stocks versus the index, where you can see towards the right is where all the cheap stocks are. Well, that's where we pretty much own all our securities. We're not closet indexing. Same thing for momentum. So that's great, but more importantly, just to reiterate, is factor investing reality is over the long haul, you're going to earn these returns because you own higher fundamental risk and you're loading into essentially this career risk trade. And that sounds great on paper, But in reality, it's more important to recognize that we are in a world that rewards, pain and gain roughly in line. So if you're going to do this stuff and you're going to go in factors, they're not free lunches. They're just different lunches on the menu that you can choose to select or not, depending on your ability to withstand these sort of pains and risks that I've been talking about here. So in the end, factor investing it creates a problem in the sense that as you increasingly make your portfolio different, you increasingly, maximize behavioral challenges. However, the silver lining is that could also create an opportunity, because if you happen to be in a mental state of mind where you really do have long horizon and a capacity to be different and kind of constrain your behavioral problems, in theory could be an opportunity for those unique individuals out here in the world that happen to be able to do that. So I'll leave you with that, and I'll take any questions if you guys have them from here.
So I have a question.
Sure.
When you, I guess, look for value companies to invest in, how do you, I guess, personally assess whether they're, that way because they're going to go out of business, or way that they're actually worth, investing in?
Yeah, so I mean, I obviously wrote a whole book about that called Quantitative Value. That is 300 pages of pure boredom, but I'll give you the summary. So the summary is it's impossible to do that perfectly. But as a general rule, like if you're just focusing on buying generically cheap stocks as a bucket, you're obviously going to get some losers in there, right? Because as I mentioned, like cheap stocks, I'll pull it up here, they fall into this equation. You're owning generally higher market risk and higher career risk, but it's not just pure career risk. You generally are owning firms that the reason they're so cheap is because there's a lot of market risk out there. So that's just part of the deal. Like expect when you own value that part of the reasons you probably are going to get to earn on average higher returns is you're going to own crappier companies. Now, at the margin, all else equal, if you have two firms, let's say that have a PE of 5, and one firm is, year over year, they're increasing their net income, they're paying down their debt, just good old fashioned kind of Ben Graham quality stuff. And the other firm that has a PE of 5 is a total dirtball. Well, on average, the more you can kind of separate out amongst the cheap stocks, those that are higher fundamental quality versus lower fundamental quality, at the margin, you might be able to improve your odds. But the best thing to do from an expectation management perspective is just recognize that when you buy value stocks, you're buying, in general, junkier, higher risk firms. That's why they're cheap, and that's why you're getting paid. And so that's just kind of part of the deal at some level, is what I would say.
We have a question from the audience, Sherry,
Sure.
Who says, what about dividends and value? How does that affect what you're talking about?
Sure. So we wrote a paper on this where we basically looked, as published, I don't even know, probably 8 or 9 years ago. But what we looked at is, well, dividends are kind of interesting because a lot of times people say, oh, let's just go buy high dividend securities. I think that's a great strategy. And then there's other people that say, well, let's buy high dividend strategies, but now people don't pay out dividends, they buy back stock, i.e. there's like a shareholder repurchase yield. And then other people say, well, sometimes people don't pay a dividend because they want to pay down the debt. So there's like a debt repurchase yield. Anyways, there's all these combinations of ways you could measure shareholder yield is basically what people call it. And what we did in our study is we said, let's just go look at all of them. Let's go look at what is the long-term performance and profile of portfolios that, buy the highest dividend securities, the best shareholder yield securities versus all the other kind of known value metrics, right? Well, long story short, high dividend yield investing is basically a rough proxy. Like the reason that works on average, or at least has historically, is because essentially it's kind of a noisy value strategy. The problem is it's actually kind of a crappy value strategy. So all else equal, on average, and what the data seem to suggest is that when you're doing basically a high dividend yield strategy, you're essentially doing kind of a noisy value strategy. And so dividend strategies will work to the extent that you're actually buying underlying cheap securities. But what gets people in trouble with dividend investing is a lot of corporations obviously cater to dividends, called dividend catering. And so what will happen is the underlying securities themselves can get expensive, and they're no longer value. They're just high dividend yield because they just pay out all their net income. Those on average are terrible investment opportunities, right? You don't want to just own high yield if the underlying firm is expensive, because now it's, that's not a good deal. And then you also got to be real careful, obviously, of just looking at high yield, because we already know that corporations tend to want to exploit and cater to dividend lovers because people like dividends so much that they might make things look like it's high yield in the short run, but like GE, it turns out that the emperor has no clothes. So I think, dividend yield strategies are fine, especially if you value the dividend yield, but you just want to ensure that the underlying value characteristic or the cheapness characteristic of that basket of dividend stocks is still good. And obviously, you also want them to have high quality and make sure they're not, just doing dividend catering, basically. So there's just trade-offs, I would say.
What do you think about, this is just like a overall question, for a while, it seems like, people avoided the banking sector just because we were so, late in the business cycle. Now that, we've had this major correction, of course, the banking stocks are so, it seems a bit undervalued. What are your thoughts about that sector?
Yeah, so my thoughts always boil down to this simple chart you're looking at here. And I can literally address any question about every investment in the entire world with this chart. So let's think about banking stocks right now. But let's actually fast forward and think about banking stocks like the last 5 years or 10 years maybe. First off, why have they underperformed the last 10 years? Well, remember, 10 years ago when you bought banking stocks, there was definitely huge negative sentiment, and i.e. probably some element of mispricing. So clearly you're taking a lot of career risk by loading up on them, but you also were eating a lot of market risk because, banks were risky. They're going out, but they're going bust. You know what's going to happen on the interest yield curve, etc. It turns out that the fundamentals of banks ended up stinking because you were buying a lot of market risk, and relative to other securities, they've underperformed. It's been one of the worst value trades ever. Fine, that's all good. But we got to invest out of sample. So right now, what's the situation? Well, it's pretty much the same. Clearly, the sentiment on owning banking or finance companies right now is absolutely horrific. And it's likely that the baby was thrown out with the bathwater. But to exploit this, you're going to have to take on massive career risk because the volatility and the movement in those underlying securities are going to be crazy. So there's definitely going to be a career risk component. However, there's also a fundamental market risk component to owning financial service companies right now, because they're obviously highly levered to what the government's going to do, what interest rates are doing, and et cetera. So the bet definitely, in my opinion, has high expected returns. And on average, if I could run the world, a million simulations right now, and you had a gun to my head, you say, hey, what's going to outperform, bank stocks or the S&P? I would say bank stocks are. However, remember, this is an expectation, and the reason that bank stocks will earn higher average returns in expectation over the next 10 years is because they're fundamentally riskier and you're going to take a lot of pain. And unfortunately, I can't predict the future, but if it turns out that the fundamental risks actually are borne out, like let's say we go into a Great Depression, I'm not saying that's going to happen, but it is possible. Well, obviously owning bank stocks would be a massive negative underperformer. So that's the way I kind of think about all bets. Like, where's the market risk? Where's the career risk? If it's high, I should get to earn extra money, but that doesn't mean it guarantees you're going to earn extra money. It just means an expectation you will. So you want to probably pool a bunch of bets that, have these profiles if you want to try to diversify it a little bit.
In the models and the funds that you manage,
yeah,
do you stay 100% invested all the time, or do you, put some in cash around and make that part of your calculations and part of your?
No, it's hard enough for people. Like, we try to be super transparent about what we do, and it's hard enough for people to wrap their head around like all the stuff I'm talking about right now. And it's just, okay, value. How do you guys do value? How do you save for portfolios? And that's one thing that takes people a long time to try to get to. And then if we were to embed basically market timing risk in there, or market timing components, it would be even more complicated. And so most of our factor products are just basically super concentrated factor exposures if people want to, do this kind of stuff. And it's 100% invested, and we're not doing the timing bet. That would be on the individual to do so. Now, that said, we do have one strategy we run that's actually more complicated even than this stuff, where we do basically leverage trend following concepts, if you guys are familiar with those, where essentially trend following simply is if risk is in a positive trend, own it. If not, get out of the freight train's way. And so we have a strategy that basically does that, where it'll own factors, and be long the market if the market's trending. But like right now, obviously we don't have any market risk on because, the market's not trending right now. So we do have a very specific product that does that. But in general, we avoid timing bets, and we push that to the individual or institution who's trying to allocate.
We have another question. This is from Paul Harms. Do you
Sure.
include bonds in your strategy?
Yeah, we don't really. I mean, I know a little bit about bonds. I know a lot about bonds, but not enough to like make products about them. And so that's not a decision that in our particular like ETF products per se that we mess with. We do manage some SMAs for like some ultra high net worth folks, where obviously one component of a diversified portfolio is bonds and bond exposures. So we'll put them in there, but we don't add bond components or fixed income into what we do through in our asset management business. But I obviously recommend that people do consider them in a broad, diversified, low cost, tax efficient portfolio.
Do you have any thoughts about, if people were to invest in some of the ETFs you're talking about, how much of their allocation could be given to that strategy?
Yeah, I mean, it goes back to, I'll show you this chart right here, right? So I mean, we invest all our own money in our own stuff, because we're crazy and we understand this stuff. And, I'm young, I got 20-year horizon, and I used to be in the Marines. Like, I can handle a lot of chaos and it doesn't even affect me. But most people aren't like that. So for a lot of people, like our stuff, especially if you watch CNBC every day, I recommend you put zero in it. You should probably just buy Vanguard funds and call it a day and just don't pay attention to the stock market. Now, and then, so between me and the person that, day trades all day that should probably own Vanguard funds, there's something in between. So for most people, the way we would recommend the use of our stuff is kind of like an 80-20. 80, like, and this is just specifically to your equity risk. So, if you're running a 60-40 portfolio, let's just say generically, of the 60% is what I'm talking about. 80% should probably just be in like insanely low cost, cheap, passive, buy everything. And then maybe you take a 20% bet on these aggressive factors because they're obviously going to like bounce all over the place. Something like that might be appropriate for someone who understands what they're getting into. But that 20% again could range from 0, which is probably what should be the case for most, and then maybe 5% for someone who's got 20-year money, they don't want to deal with it, or, maybe 100% if you're a complete lunatic who's into factors like myself. But so it's kind of a hard question to ask precisely, but it would kind of depend on anyone's given situation and belief in psychology and all these good things.
Got it. Thank you.
We had one question about, do you use options in your strategies or futures or anything else?
Not in our ETF strategies. I mean, we run like internal managed futures program. We do everything you could ever imagine where we do all that kind of stuff. But in the ETF public products, it's just good old fashioned concentrated factors, right? And so there's no options or derivatives or these sort of things. It's just pretty straightforward. But we do trade futures there's a business like CTA managed futures business where we do that, but it's not really something we do in the public domain. It's like a private business we run. It's usually inappropriate for vast majority of people just because of the volatility and complication and everything.